Hello and welcome to a recap of our lecture that covered more on the group statement of financial position. So this is a really important session. It covers post-acquisition profit, the consideration paid for a subsidiary, and fair value adjustments, one of the most important areas on our group accounts. So let's remind ourselves of what we looked at in this lecture. Well, the first thing we talked about was post-acquisition profit, and that was where we acquired a subsidiary prior to the reporting date because, of course, the subsidiary will earn profit between the acquisition date and the reporting date. So they should earn profit. They may calculate a loss, but that's fine. We treat it in the same way. We can work out what that profit is in our working to. The difference between the net assets at acquisition and the net assets at the year end will be that post-acquisition profit because, of course, the retained earnings will have gone up. So we take the parent's share of this to working 5 and the NCI's share to working 4. We didn't have to worry about pre-acquisition profits because remember it was included in the net assets at acquisition and that was cancelled out in our goodwill working. So we looked at illustrations 3 and 4 to go through detailed examples of post-acquisition profit. So do attempt those again if you're not sure of what we mentioned here. We then moved on to look at the consideration that was paid for the subsidiary. There were basically 5 different types of consideration, and we needed to treat each one. First of all, we had cash, and cash we just brought in as the amount that was paid. For the rest of these ones, we had to try and find the fair value. So for example, if the parent issued shares for the subsidiary, well then we used the market value of those shares. That would be the fair value. We then had some tricky ones like deferred consideration. Remember, this was an amount that would be paid later. And we had to bring it in as the present value of future cash flows. So the present value of the amount we were going to pay, i.e. we needed to discount the amount. Now we needed to learn how to do this. We did it by calculating the discount factor, which was 1 over 1 plus the discount rate as a decimal to the power of n. And remember, n was the number of years until we had to pay it. So we multiplied the amount that we were going to pay by the discount factor, and that gave us our deferred consideration amount. The treatment for that then was we created a liability. We debited goodwill, we credited a liability, and then we unwound the discount each year until we had to pay that deferred consideration. Now we did a detailed example of that with 10,000 being paid in 3 years at 10% of a discount rate. If you're not sure of anything I mentioned here, then go back and look at that and learn how to discount your deferred consideration and how to unwind that discounting over the 3-year period, because that's important. If this comes up in the exam, they're likely to give you exactly that. We also then looked at contingent consideration. Remember, this was similar to deferred consideration, except it depended on an event. So we would pay you 10,000 in 3 years if you hit certain profit targets, for example. So it's similar to deferred consideration. We would treat it the same way. So if it was cash paid in a number of years, if they hit that target, well then we create a provision. But then if we don't have to pay it, we would de-recognise the provision as a gain in the income statement. So contingent consideration treat the same as deferred consideration, except if you don't have to pay it, you would de-recognise the provision. So we looked at all of those in illustration 5 to make sure we could calculate them. The last one we had then was loan notes. Basically, you just had to work out how many loan notes were given and how much they were worth. And then we created that liability for the loan notes. Once again, we looked at that in illustration 6 to make sure we could do the calculations. The last thing I wanted to look at in this session were the net assets, because often you'll get fair value adjustments. So we talked about a situation where if we acquire a subsidiary, IFRS 3 requires us to measure the assets and liabilities of the subsidiary at fair value. However, they may be at historic cost in the subsidiary's own accounts. If they are, well then we need to make an adjustment to bring them into the group accounts at fair value. So we need to change them from historic cost to fair value to bring them into the group accounts. So this is usually going to be land or property or plant. For property or plant, not so much land, you may also have extra depreciation to deal with, and we'll show you how to do that. So how did we go about doing that? Well, we adjusted it in our working two. What did we do? We added our fair value adjustments. So that's the difference between the historic cost and the fair value. We added it as a fair value adjustment to the net assets at the year end and at the acquisition date. If there was any additional depreciation required, then we subtracted that at the year end only in our working two. On the statement of financial position then, we added the fair value adjustment to the assets when we added them across, and we subtracted the depreciation from the asset as we added them across. So there were two adjustments, one in your working two and then one on the statement of financial position when you're preparing it and bringing it together. So we looked at an example of that in illustration 7 to make sure we could do it. So for those net asset adjustments or fair value adjustments, we needed to be careful exactly what they were. There might be an increase in an asset, in which case we would add it to the working two and our statement of financial position and then subtract any extra depreciation. But it could also be a decrease in an asset if the examiner wanted to try to trick you. And rather than adding that in working two, you'd do the opposite. You'd subtract it in working two and in the statement of financial position, and you'd reduce the depreciation. So you need to be careful with that. The decrease in an asset is equally as examinable and is the opposite from increasing an asset. And indeed, an adjustment to a liability would be the opposite. So we looked at all of those in illustration 8, and it's an important illustration because that's the area that the examiner may try and trick you on or trip you up. So make sure you go back over illustration 8 and understand it. Lastly, we looked at some technicalities, 3 technicalities that you need to learn for these fair value adjustments. Number 1, remember that a contingent liability in a sub, that would be a note to the financial statements in the sub, becomes a full liability in the group as a fair value adjustment. Okay, remember you just need to learn these, even if you don't fully understand them. An intangible asset that may not be recognised in the sub, for example, an internally generated brand that the subsidiary is not allowed to recognise in its own accounts, is recognised in the group, because once the parent buys the sub, it's purchased that brand, so it needs to recognise it in the group accounts. That again is a fair value adjustment. Lastly then, a fair value estimate. So what we're saying is, if you didn't have an accurate figure at the year end and then you revise it later on, you need to check the acquisition date. So you estimate the fair value, you then revise it later on. If it's within 1 year of the acquisition date, adjust goodwill. If it's more than 1 year since the acquisition date, adjust the asset on the statement of financial position. Look, we looked at illustration 9 that had an example of all 3 of those, and they are crucially important. Those are the areas that the examiner will look at to see, do you know those rules? You must learn the rule that a contingent liability becomes a full liability in the group, An intangible asset that's not recognised in the sub should be recognised in the group. And if fair values are estimated and revised later, you need to check whether it's more than 1 year or less than 1 year from the acquisition date. Those are the things that will get you through this exam, learning those little technicalities. So go back over illustration 9, make sure you can do it, and make sure that you understand everything in this session. This is a crucially important session.